Welcome back to The Explainer. So today we're cracking the code on a topic that honestly trips up even the most seasoned analysts out there, and that is how we actually measure green real estate performance. Look, we hear so many huge claims about sustainability these days, right? But evaluating those claims, it's actually a lot trickier than just skimming some surface-level numbers on a spreadsheet. In fact, relying on raw numbers without the proper framework is a total trap, and it can lead to massive misunderstandings. So let's dive into exactly why that happens, and more importantly, how we can fix it.
So this brings us to the core question. How do you accurately measure green real estate? When a company drops its annual sustainability report, they usually love to highlight absolute numbers. They'll say something like, hey, we have 2 million square meters of green certified properties, or we manage 50 green buildings. And on the surface, wow, that sounds incredibly impressive, right? But I want to introduce you to a very dangerous trap that we call the illusion of absolute sustainability numbers.
Okay, let's dive into this with a quick thought experiment. Imagine two real estate services companies. Firm A comes out and says they manage 50 green buildings that have obtained top-tier energy ratings. Firm B tells you they only manage 10 green buildings. So based strictly on this raw data, who do you think is more sustainable? I mean, if you're just looking at those absolute numbers, Firm A looks like the undisputed heavyweight champ. They have 5 times the number of green assets. But as we're about to see, raw data alone is a total master of disguise.
Because, well, here's the crucial twist. Firm A actually manages a total portfolio of 10,000 buildings worldwide. That means their 50 green buildings, they represent just half of 1% of their total operations. It's literally a tiny drop in a massive and likely very carbon-heavy bucket. Firm B, on the other hand, manages a total of 10 buildings, and all 10 are green. They're operating at 100% sustainability in this category. This perfectly illustrates why we desperately need a denominator. Because without knowing the actual scale of a company's total operations, those absolute numbers mean absolutely nothing.
To solve this, we rely on the SASB standards for real estate services. Here is our roadmap for today. We're going to define the absolute data illusion, uncover activity metrics, dive into core real estate metrics, learn to normalize that data, and finally, look at why this context matters so much. Starting with Section 1, the absolute data illusion, and how it acts as a dangerous trap in industry reporting. When we check out the sustainability disclosure topics in the SASB Real Estate Services Standard, specifically metric IFRS-410A3, we see it asks companies to disclose things like the floor area and the number of buildings under management that obtained an energy rating. Now, don't get me wrong, this is fantastic data. This is what we call our numerator. It tells us how much good a company is actually doing. But just like we saw with Firm A and Firm B, if this numerator is just hanging out there all by itself without any context, it creates a total illusion of performance. Investors just cannot make informed decisions based on this alone. Moving right along to Section 2, activity metrics, and how we use them to completely break this illusion. The SASB standard actually gives us a really clear definition. It states that activity metrics are designed to quantify the scale of specific activities or operations by an entity, and are intended for use in conjunction with the metrics to normalize data and facilitate comparison. So, what does that mean in plain English? It means activity metrics are our denominator. They tell us the total size of the pie, so we can finally figure out just how big of a slice that green numerator actually is.
Which brings us to Section 3, core real estate metrics and establishing that crucial operational context.
Now, what's really interesting about this is that it isn't just theory. The IFRS 000 series is the actual, tangible, industry standard framework used globally by the ISSB to establish operational context. And here are those core general activity metrics listed out. We've got the number of property management clients, floor area under management, total number of buildings, the number of leases transacted, and the number of appraisals provided. The standard explicitly guides us on how to use these general activity metrics to properly contextualize and compare sustainability performance. So think about it. If a company reports massive revenue from energy and sustainability services, you need to look at their total number of property management clients to see how deeply penetrated those services actually are across their entire client base. Or, if they're arranged in green leases, you compare that against the total number of leases transacted. These metrics quantify the true real-world scale of a real estate entity's operations.
All right, Section 4, normalizing data to build actionable insights.
This right here is where the mathematical synergy happens. It's a simple process.
Step 1. An analyst identifies the sustainability disclosure metric. Let's say the floor area provided with energy and sustainability services. Boom, that's your numerator. Step 2. They find the matching activity metric, the total floor area under management. That is your denominator. Step 3. They just divide the numerator by the denominator to calculate the normalized percentage. And suddenly, the fog completely clears, and you have a true, honest rate of performance.
And this brilliantly illustrates the whole concept. By dividing that green floor area by the total floor area under management, we get a true representation of exactly how much of a company's total footprint is actively being managed for resource efficiency, utility data, and energy procurement. We're no longer blinded by just raw square meters, We're looking at the actual reality of their operational commitment to sustainability.
Finally, let's wrap up with Section 5, why context matters for true comparability.
Normalization totally levels the playing field. Without it, massive global real estate firms will always appear to outperform niche, local agencies purely by virtue of their size. It's just math. But by utilizing activity metrics, a local firm managing just 20 buildings could reveal a 100% integration of energy-saving services. That proves they are vastly more efficient and forward-thinking on a relative basis than some global giant sitting at a 2% integration rate. Context is what drives true comparability across the entire global real estate value chain.
And we really have to remember why we're measuring this in the first place. The SASB introduction plainly states that these standards aid entities in disclosing information about sustainability-related risks and opportunities that could reasonably be expected to affect the entity's cash flows, its access to finance, or cost of capital. So, contextualizing data, it's not just an exercise in feeling good about being green. It is about cold, hard financial viability. Buildings with better energy ratings actually have higher asset values, decreased operating costs, and increased tenant demand. Understanding the true proportion of a company's green portfolio helps investors accurately price risk and forecast those future cash flows.
So, I want to leave you with this final thought for today's explainer. When you evaluate the real estate companies in your own portfolios, or honestly, even when you just read the latest flashy sustainability report, are you looking at the full equation, or are you just being sold the numerator? Remember to always look for those activity metrics, find the denominator, and discover the true story behind the data. Thanks so much for joining me on this deep dive, and keep asking the right questions.